Hey everyone, welcome back to the Daily Gold Podcast. Today we're speaking with a new guest. He's John Kaiser of Kaiser Research Online. And John, as we get started here, you put out publicly some great research on really the state of the exploration sector. Obviously, it's been very difficult for most of the companies there. Many analysts are talking about the low cash levels and so on and so forth. And those analysts are basically using your research to put forth their own views. So I wanted to get you on here, and there's so much information in this piece. I'm not quite sure where to start, but maybe we could just start right from the top, and you could just go over maybe that first chart there, and just kind of talk about the cash situation of the junior sector, and then how you see that playing out, I guess generally speaking, over the next year or so.
Okay, Jordan, let me just sketch out some background. Kaiser Research Online is focused on tracking all the Canadian listed companies involved in the resource sector. And currently we have 1,800 companies that are still actively trading, most of which are still in the resource sector. And we maintain databases on these companies. We take all their quarterly financials and update them regularly. And this has given me the ability to actually survey the landscape of who has how much money. And I recently crunched the numbers, and I was devastated to find that 632 of these companies, quite a large percent, have less than 200,000 working capital in their treasury. And these are companies which, unless there is some wave of enthusiasm for the sector, will not be able to raise enough money to simply exist doing nothing beyond another year. So these are the companies where I talk about companies, 500 companies that are on the extinction list unless the sector turns around. Now, everybody's focusing on these potentially doomed companies, but there are 506 companies which I classify as exploration, discovery exploration oriented. In other words, they do not yet have a resource estimate in a project that is their flagship. These do have more than 200,000 working capital, and there's 428 companies with more than 200,000 which have a project that's at an advanced stage where they're trying to demonstrate the feasibility of an existing resource. So there's almost 1,000 companies there which I think will survive, and these are the ones that one should target right now in doing bottom fishing, where you look for the companies where a market that is so biased to the negative scenario for the future that they're plugging much lower metal prices than we actually have into their cash flow models. And of course, the glass is half empty as far as discovery exploration goes. Yes, give me 200 meters of 10-gram gold and we'll buy the hell out of your stock. But don't tell me about your target. We don't care. We don't believe. We think you are all going to be failures. This is a fabulous bottom fishing window. The only thing that concerns me is that unless there is some change in the attitude of the public with regard to the wisdom of putting speculative dollars into the junior resource sector, we may not just see 500 companies disappear. We may see an entire institution go by the wayside, eliminating this great thing called the Canadian junior resource sector.
Yeah, and I want to get to your next chart where it shows private placement activity, and I guess there's so many questions I want to ask you about that, but I'll try and whittle it down to a few. I guess my first question would be, looking at that chart, the fact that obviously it looks like we made a bottom in July, can the low in private placement activity, can that chart kind of be used for a contrary indicator? I guess I'll let you answer that first.
Well, the chart goes back all the way to January 2002, and that was 2002 was really a dismal time for the junior resource sector. The first wave peaked in 2007, and we went back almost to 2002 levels during the financial crisis of 2008. But what's really interesting is that we had a tremendous financing window after the crash, during the last 3 years, during which we also saw traded value go up higher than we had during what's generally regarded as the heyday between sort of 2005 and 2008. Keep in mind, this is TSX Venture. What I'm seeing is that if you need to raise $30 million plus for an advanced project, typically you're already on the TSX, you can get money. What seems to be very difficult to get is the in the sort of $3 to $10 million range, which are the smaller companies that tend to be on the TSX Venture Exchange. The thing that's disturbing about this market is the collapse in the traded value out there. The institutional money has exited the sector because they see us at best having flat metal prices heading forward and a weak global economy. So the whole super cycle narrative that attracted the institutional investor, that is now on hold. And the retail investor, they were not a prominent part of this boom during the last decade. This was more a number cruncher's paradise, focused on the failures of past exploration cycles, deposits that were found during the past 50 years that didn't quite have the grade to go back into production then, but when China came along and ramped up global demand and dragged the real metal price back into an upswing, all of a sudden these were hauled out of the closet. They ended up in the juniors, and we had over $100 billion worth of takeover bids during the last decades as the majors scrambled to acquire these projects and put them back into the fold. That cycle, I think, is over. We're really in an air pocket here. We need retail investors to come back and speculate on discovery exploration type plays. But we only had a handful of really big winners in the last decade. Eleanor from Virginia Gold, Fruta del Norte from Aurelian. Almost all the big takeover bids involved the recycling of former discoveries.
Talking about the majors and potential acquirers, I mean, looking at the producers, what's interesting to me is if you look at the last 12 or 18 months or so, I know there's been numerous companies that have had problems, and I know you focus on the real price of gold, which, I mean, as you point out, is very important because that's what drives profits. It's not just gold, zooming up to 2,000. Looking at a lot of companies that have done well in the last couple of years, given where their share price and where their value is, and then looking at all these juniors, I guess what I'm getting at is I feel like these bigger companies that have the cash, that are in a good situation, do you see them at some point just starting to pick off a lot of these smaller companies and picking off these assets, for pennies on the dollar?
Well, what I'm observing is that the really big producers have had these monster projects with very big world-class deposits that are costing $5 billion. In fact, one of them, the Olympic Dam, was a $20 billion expansion of an existing mine. They are now shelving these projects because the capex cost has escalated so dramatically. And we've heard this figure that although CPI in the United States has been 2 to 3% annually for the past 4 or 5 years. In the mining sector, capital costs and operating costs are declared as having increased 10% annually, which means that the costs have, in the last 4 or 5 years, actually increased 50% from what they were at the end of 2008 when the market melted down. This has eroded much of the real price gains that were implicit in, copper at $350, gold at $1,700. So even though these metals have not crashed back to pre-China levels, still hanging near their all-time highs, the costs have crept up and snatched away a lot of this implicit profit margin. So with regard to the majors shelving their very big projects because they're unsure of where the demand is going to be in a global economy where the United States is still not definitively back on track, where China is finally stabilizing a significant slowdown in its growth rate, and the Eurozone continues to have problems and could yet collapse on us. In this type of context, they're worried that there will be significant new demand. They have taken over quite a few projects in the last while. Question is, of these 400 companies that are out there with projects, will there be an appetite for them? I think there will be. They are generally smaller projects. The big mantra has been big is beautiful, but perhaps small is better. If you put in a number of these smaller scale projects, you don't have so much capex at risk that you might get nationalized, or we have another global downturn and the price goes below the operating cost margin. I expect that if we simply see an inflection where the industry thinks, okay, the worst that's going to happen to metal prices is nothing. They're going to stay where they are, not going to go up or down significantly, just motor along sideways, and the the CapEx and OpEx cost escalation that we've seen has now stabilized. It was largely a catch-up that happened as a result of the big increase in demand for raw materials during the past decade. Then I can see a wave of M&A cleaning out the best. But a good chunk will be left stranded because their grade will be too low. The expectation in a higher metal price will be absent. And so these will fall by the wayside. And I think the market's focus is going to shift away from resource feasibility demonstration to finding new deposits that work very, very well at current metal prices and perhaps even at considerably lower metal prices. So we're back to sort of what we had in the 80s and 90s, where it was all about discovering new deposits that worked at what were the prevailing prices during the 80s and 90s, which did not change significantly during that 20-year period.
And just a quick follow-up on what you said, talking about the smaller projects, what levels of production? I mean, I know there's a big variance there, but are we talking about, 75,000 ounces, 125,000 ounces, something in that area, or is it larger or even smaller?
Well, if we're talking gold, a project should be capable of producing 100,000 ounces a year. So that means you need to have 1 million ounces in the ground so that you can have a 10-year mine life. You really need a 10-year mine life to justify putting a deposit into production. So for the juniors, the magic number is 1 million ounces gold. More is always better. The mid-tiers want 3 million ounces plus. Examples of companies that are getting away with this smaller production and actually attracting an audience are companies like Timmins Gold, which you might call that a small-scale operation, but it is profitable, and companies like this will have the ability to acquire other projects that can be put into production that close to that level of 100,000 ounces a year. At some point, these companies will end up being acquired by the mid-tiers, and the mid-tiers will end up being acquired by the big tiers, because there is a shift underway where producers are not being treated as proxies for gold anymore. They are being treated like cash flow producing base metal companies. And there's, with the demographic shift that's happening where the boomers started retiring a year ago, and with yields very low in other instruments, there is a hunger for dividend income. So the mining industry is being told, even by members of the gold mining sector, that we need to start paying decent and stable dividends to our shareholders. And that means capital gains within the producing sector is not going to happen, and they're going to have to look for profitable operations that they can acquire and put into production. And that may be involved the smaller scale type of projects that the juniors can find and that are currently available for them to take out, rather than this, we want 5 million ounce plus deposits. That's been all the mantra during the past decade. It's not so easy to find large ounce deposits with a decent grade. There's lots of low grade stuff out there, but the capital and operating costs have pretty much rendered those marginal.
Now, John, you already touched on, what we possibly can expect to happen if metals prices generally stay where they are. Of course, most people who are involved in this sector, we do have a bias, thinking metals prices are going to go higher, as I believe. So, I mean, hypothetically speaking, let's say in the next couple of months or before the spring, we see silver break $35, we see gold break 1,800 or 1,900. What effect do you think that would have on the exploration sector, and would that change the thinking of some of the potential acquirers?
Well, one of the key narratives out there is that gold and silver are money, and they're going to go up in value because there's hidden inflation coming, there's currency debasement coming, and insofar as what we're really after is cash flow, in other words, the profitability of a gold mine, that narrative is not going to do anything for the juniors, because a deposit that doesn't work today, in other words, isn't economic, isn't going to be economic if gold's at $5,000, because now it costs $4,990 an ounce to produce the ounces that company owns. The other narrative, the one I sort of favor, is I think silver and gold prices for the next 4 years are stable, plus or minus 10 to 15%, but can spike higher in the event of geopolitical crises. For example, suppose Israel decides that it has to go and bomb Tehran's nuclear facilities and unleashes just a disaster in that part of the world. Such events could cause gold and silver to spike in real terms. The question is, in circumstances like that, will people feel compelled to chase after juniors that own deposits that are suddenly in the money in a big way? I personally think that if we do get a crisis like that, it will not help the juniors right away. But when the crisis stabilizes and gold and silver come back to levels that presumably will be higher than where they are now, then we will get a proper bull market kicking in. Because I think the problem right now is people actually, despite what they tell you, they actually fear that gold and silver are going back to $15 and $1,200 in the next while. And until that fear is eliminated, there will be a reluctance to embrace gold and silver resource juniors.
Now, John, one last question before we close. I mean, you talk a lot about rational speculation. Could you just clarify what you mean by that for our listeners?
To speculate is to place a bet on an uncertain outcome. And if you know what the underlying odds of that outcome being delivered are, then you want to get a payout that's equal to that multiplier. So that's called a fair bet. So it's rational to speculate on something where the odds match the expected payout. And of course, in the market, we get situations where, like right now, the payouts are potentially much better than the underlying odds. So we get actually good bets, good speculative value. In bubble-like markets, the payouts are much lower than the underlying odds. So that gives you poor speculative value. So what needs to be done is when you're looking at these juniors, you need to visualize for yourself what is the potential outcome worth. And given the stage that the project is at, there'll be an error margin in terms of how reliable your visualization is. So a stock that doesn't even have a discovery yet should be at maybe 5 to 10% of what you imagine the outcome to be. And so you create a discounted value that you're willing to pay now, and if success is delivered, the stock would increase by the multiplier that reflects the underlying odds. That is rational speculation, and it can be done in this sector because unlike some widget business or internet business where you could end up selling a gazillion of this stuff, there is a finite limit to the value of a deposit, and that's constrained by the price of the metal and the cost of producing it and the size of the deposit. So working back from an upper limit, you can relate that to how the market's valuing it right now and actually engage in a speculative activity which is quite rational and quantified.
Okay, John, before we close, can you be so kind to just tell our listeners how they can follow your work and how they can subscribe to Kaiser Research Online?
Our website's address is kaiserbottomfish.com, no hyphens. There's a one month trial for $100. You do a first-time registration. We do two key things. One is we have all this information on all the companies, good and bad, and we have a very powerful search engine so that if you know what you want to buy or short, you can find it. The other stuff we do is we actually use this search engine to come up with our own picks. We make our own recommendations. We've got 102 open bottom fish recommendations right now, and we have about 30 spec value hunter picks, which are formal recommendations where we explain what it is that we like about the company, what needs to happen, and we provide a reasonably continuous coverage as to how our picks are working out.
Okay, John, I know you're traveling soon, so I know your time is limited, and because of that, I really want to thank you for joining us today. Just great insight and analysis. I really appreciate it, and I'm sure my listeners will. And I look forward to seeing you in person, hopefully in Vancouver soon.
Yeah, thank you very much, Jordan, for having this interview with me.